One of the most common questions I get asked as a CPA from business owners is, how do I pay myself? In this video, I'm going to cover how to pay yourself as a business owner. Hi, I'm Jenny Schottmiller, CPA from Simple Profit. I make accounting and tax topics easy and understandable for every business owner. How you pay yourself as a business owner depends on how your business is formed. There are generally 5 forms of business: a sole proprietor, a single member LLC or PLLC, which means professional limited liability company, a multi-member LLC or partnership, an entity taxed as an S-Corporation, or a C-Corporation. The first is a sole proprietorship. There's no real formation to your business. You just started a business. You're running a business. And it is not in a separate legal entity from you as a person. If you are a sole proprietor, then you're gonna pay yourself with owner's draws. And an owner's draw means that you're gonna take the money from your business when you want in an amount that you have available. You can transfer this money to your personal account, or you can write yourself a check. You might hear from some accountants that a check is preferable because then there's a paper trail. But it's 2020. We don't do much with paper anymore. The IRS allows us to file our tax returns and pay them electronically. So it is not required that you have a paper trail for paying yourself. It is okay to transfer the money. The main thing with the sole proprietor is that it is the simplest way to pay yourself. You're just going to take the money out of your business when you're ready. One common question I get from sole proprietors is, well, I don't want to take the money out of my business because I don't want to be taxed on it. A sole proprietor is a pass-through entity. What a pass-through entity means is that your business itself is not going to pay any tax. Each year, the revenues and the business expenses are going to flow through to you and be reported on your personal tax return. So you are going to pay taxes on the money that your business earned, revenue less expenses, whether you take that money out of your business or not. So you can manage your cash flow based on what's going to be best for you as the owner, and don't worry about the tax. Well, do worry about the tax. Pay your estimated taxes, but you don't have to worry that taking money out is going to increase your taxes. A sole proprietor pays income tax on the money earned as well as self-employment tax. A single member LLC is a business where a limited liability company or a professional limited liability company was established with your state. The IRS doesn't recognize LLCs. They know they exist, but they're not a federal business structure. So a single member LLC is taxed the same as a sole proprietor. What this means is you also pay yourself the same as a sole proprietor. You can transfer the money when and how you want. A single member LLC, just like a sole proprietor, pays income tax on the money earned and self-employment tax. And just like a sole proprietor, all of the revenue and expenses are going to pass through to the single owner of the LLC each year on their taxes, and they'll pay tax on the earnings, whether or not those earnings were paid out of the business account. So just like a sole proprietor, a single member LLC is a very simple business structure, which is flexible and makes it easy for the owner to pay themselves. A partnership is a structure, either an LLC or it might not have an LLC structure, where more than one person owns the business together. When you have a partnership, it's vital that you have a partnership agreement, and the partnership agreement is going to determine when and how the partners are paid. The way the partners are paid is just like an owner's draw, and just like a sole proprietor or LLC, all the earnings of the partnership are going to pass through to the partners and be reported on their personal tax returns. However, because there are multiple people involved, there needs to be agreement and preferably documentation on how those payments happen, when they happen, how much they are, and who gets what. It's very important to speak with an attorney and get a partnership agreement And consider this partnership agreement something that is updated periodically. That's because there could be tax law changes, there could be changes in how your business is operating that you want to consider. So revisiting the partnership agreement periodically is a really good idea. As long as you're following the partnership agreement, the payments to the partners are pretty easy. You can transfer or pay the amounts in check. Partners are also considered self-employed and pay self-employment tax in addition to income tax on their earnings. If your business is an entity taxed as an S corporation, what that means is that you're either an LLC or a C corporation that chose S-Corp tax status. And when you elect S-Corp status, a couple things change with how you pay yourself. The first is that you're going to need to develop a reasonable salary for the work you're doing in the business. Check out my other video on developing a reasonable salary for a corporation owner. Once you develop the reasonable salary, you're going to need to set up payroll. This payroll needs to be W-2 salary. You're going to get a W-2 at the end of the year, just like an employee. And that's because as an S-Corp owner, you're both an owner and an employee at the same time. So you're going to have some amount of what you earn in the business paid to you as the salary. The rest of the money that the business earns is profit to you. And S-Corp is also a pass-through entity. So you have your revenues from the business, you have your business expenses, and the salary that was paid to you as owner. The remaining amount is profit. And that profit is going to be taxed to you, the owner, on your individual tax return. Just like a sole proprietor, you're going to be taxed on that profit whether or not you took it out of the business. What that means is the cash remaining in your business can be withdrawn by you as a distribution anytime you want in an amount you prefer. It's really important that there is a W-2 salary for the owner if there are profits and if the owner is actively working in the business. So if you're not actively working in your business but you own a portion of an S corporation, you don't have to take a reasonable salary because you're not doing any work for the S corporation. If your business didn't earn any money yet, you are not required to take a salary and therefore pay payroll tax on the earnings. When you are actively working in your S corporation and there are profits, it's very important to be paying yourself as a salary for the work you're doing. An S corporation is not considered self-employed. The S corporation owner pays payroll tax on the salary that they take for the business, but they do not pay payroll or self-employment tax on the profit. It is also important if you are an S corporation to make sure that you are working with a tax professional. S corporation taxes are rather complicated. It's not do-it-yourself stuff. If your entity is taxed as a C corporation, there are also two ways that the owner is going to get paid. There is also a W-2 salary representing the work that the owner is doing in the business. In addition to that, there are dividends. The difference with a C corporation is the C corporation is a tax-paying entity. So every year there is going to be a return for the C corporation, and the C corporation is going to be taxed on the net profit of that business. Your own salary is a business deduction for the C corporation, and you pay tax separately when you report that W-2 on your taxes. Another difference with the C corporation is the money is going to accumulate in the business, and you're not going to be taxed on the owner's profit until it's actually paid out to the owners. Whereas the S corporation, you're going to pay tax in the year that the profit was earned, whether or not you take the money out. A C corporation is paying 3 taxes. The C corporation itself is paying income tax, the owner is paying income tax and payroll tax on their salary, and the owner is also going to personally pay tax on the dividends when the dividends are distributed to the owner. To sum it up, how you pay yourself is dependent on how your business is formed. The sole proprietor and LLC, especially a single member LLC, are simple and easy. A partnership, an S-Corp, and a C-Corp are more complex, and the S-Corp and C-Corp require that the owner is both an owner and an employee, and that there is, in most cases, going to be a reasonable salary if there's profit and if the owner's actively working in the business. Post below what your business is formed as, and if you're clear on how to pay yourself, or if you found this video helpful, make sure to like the video and subscribe to the channel. Check out these other videos from me and Simple Profit that you might find really helpful.